Assalamualaikum and hi to our beloved lecturer Puan Aizia binti Abdul Rahman and my fellow friend. Today, our group would like to present about the method of revenue recognition. Before we go further, let me introduce myself first. My name is Nur Syazwani binti Mat Taib, metric number 01DIB19F1028. So, what is definition of revenue recognition? Revenue recognition is an accounting principle under Generally Accepted Accounting Principle (GAAP) that determines the specific conditions under which revenue is recognized or accounted for. Generally, revenue is recognized only when a specific critical event has occurred and the amount of revenue is measurable. However, there are several situations in which exception may apply. Now, we go to the method for revenue recognition. The first method is completion of earnings and assurance of payment. With the completion of earnings method, the seller must not have a remaining obligation to the customer. For example, if an order for 500 football helmets has been placed and only 200 have been delivered, the transaction is not complete. If the seller is the manufacturer of appliances and promise extensive warranty coverage, it should not book the sale as revenue unless the cost of providing the service, which is warranty, repair, labor and part, can be reasonably estimated.
I will go through to the next method, which is sales-based. This method probably makes the most sense to investors. Under the sales basis method, revenue is recognized at the time of sale and can be for cash or credit, such as account receivable. Revenue is not recognized even if cash is received before the transaction is complete. For an example, a magazine publisher that sells a 120 ringgit annual subscription will only recognize 10 ringgit of revenue every month. If the company went out of business, it will have to return a prorated portion of the annual subscription price to the customer since it had not yet delivered the product. We go through to the next method, which is percentage of completion. First, there needs to be a long-term, legally enforceable contract between involved parties. It must also be possible to estimate the percentage of the project complete as well as future revenues and costs. Under this method, the two ways to recognize revenue are by using milestone or cost incurred to estimate the total cost. Imagine if a construction company is paid 100,000 to build 50 miles of highway equaling 2,000 per mile. Using the milestone method, for every mile the company completes, it can recognize 2,000 in revenue on its income statement. The cost incurred method is a little more complicated because in this method, the construction company will approach revenue recognition by comparing the cost incurred to date to the total cost. For an example, let's assume the construction company expects the highway to cost 80,000 in parts, material and labor. At the end of the first month, it has spent 5,000 or 6.25% of the estimated cost. It will then multiply the total revenue 100,000 by the percentage of the cost incurred 6.25% and recognize 6,250 as revenue on its income statement.
I will continue this presentation with method number 4, which is cost recoverability. Cost recoverability approach is used when the company cannot reasonably estimate the total expenses required to complete a project. For example, assume a law firm developed its own software at a total cost of 1 million. Several years later, the partner decide to start license the software to other firms. In the first quarter, they have total sale of 250,000 under the cost recoverability method of revenue recognition. All of these were served as offset to the original 1 million in the development of expenses. Nothing would appear in the income statement as revenue until the original balance of 1 million is gone. Okay, next, we move to the method number 5, which is installment. When the actual collection of cash is suspect, a company should use the installment method of revenue recognition. For example, assume a developer spent 500,000 improve an apartment. They sold the property for 750,000, but the buyer is going to pay in 2 installments, which is one in January 1 and one in July 31. The first payment due date, the developer received a check for 375,000. Their income statement is now going to reflect 50% of the revenue and gross profit earned, saying they have collected 50% of the cash. That's all from me, and I will pass this presentation to the next presenter. Thank you.
Okay, in the conclusion, with only a change of revenue recognition methods, management can drastically alter the appearance of the income statement by over or understating revenue and profit. The exact same contract using the percentage of completion method for revenue recognition instead of the completed contract method will result in higher asset, higher stockholder equity, lower liabilities, and a lower debt to equity ratio. The income statement will show how smoother earnings over several years, even though the economic substance and health of the business will be the same. Thank you.